What just happened in China is absolutely insane, a bazooka of insane, and it comes right at the same time as, quick note, we just launched stockhack.com, so if you want to book an intro call with us or sign up for actual financial advice with myself and my team, go to stockhack.com, licensed financial advice, and I cannot wait to help you with real estate and equities. Oh boy, what the heck just happened in China, and what does that mean for the United States, the US stock market, the US bond market, and inflation in the United States? We got to talk about this because as of just a week ago, China was essentially on the verge of a deflationary collapse. And just yesterday, well, technically today in China, the Central Bank of China, the People's Bank of China, turned on the Jerome Powell money printers. Brrr. This is like COVID in the United States. Maybe not to the same magnitude. They spent closer to, well, let's just say under a couple $100 billion compared to the many $4 to $5 trillion we may have spent in America. But China just did something really, really important. They may have created a floor under the deflationary disaster that's been going on in China. Think about this for a moment. Real estate prices between 2018 and 22 have fallen by 50%. The average net worth of a Chinese household has fallen by $60,000. And the average net worth of a Chinese household isn't as high as the average net worth of a United States household. So this is a disproportionately large hit, especially since 60K on average across the board. It's actually quite a big chunk. On top of that, the Hang Seng Index from 2018 to yesterday was down 46.7%, which basically means over 6 years, it's lost nearly 50% of its value. Well, yesterday, everything changed, and there might finally be a floor under the pain in China. The Hang Seng Index was up 4.1%, and this is all in response to central bank actions by the People's Bank of China, which we'll go through in just a moment, but it's worth noting this means the Hang Seng Index is now up 13% for the year as the market started rising in anticipation of some government bailout. And it appears the Chinese government has just bailed out markets. Keep in mind that the Hang Seng is sort of their Dow Jones, if you will, or maybe their S&P 500. It only represents about 82 companies, but those companies make up about 58% of the Chinese market cap. That's why a lot of folks use that as a reference, and people are calling this a stimulus cocktail. The central bank, the People's Bank of China, basically unveiled this broad stimulus package on the 24th of September. And they conducted multiple cuts and money printing moves at the same time, which is actually pretty rare because we've seen cuts to the reverse repo rate before. Cutting the reverse repo rate is just a fancy way of trying to encourage people who are in money markets or savings or banks to get out there and spend their money, invest their money, or lend their money. And at the same time as they did this, they cut down payment requirements for real estate. They loosened some borrowing and mortgage rules as well for other second home purchases, making it easier to go buy a second home. They reduced down payments for second homes. They also printed money for the stock market to use. The stock market is getting $70 billion of funds to basically go buy whatever you want. And that's going to be stock brokers and investment funds that basically get stimulus checks to go buy stocks. So generally the Chinese government doesn't directly provide stimulus checks to the consumers. They usually provide it to companies. This is just the nature of a centrally planned economy. The problem with that was people previously thought, and expert economists thought this as well, that if you stimulated manufacturers directly, they would just hire more people and expand their operations and enable them to lower prices for manufacturing even more and basically create this doom loop of deflation. And so what the Chinese central bank did instead is they said, okay, well, let's figure out how to prop up the stock market and maybe the real estate market. So that way, not only can we support those businesses with higher stock valuations, but we could also support and put a floor under the pain of the real estate market. So a $70 billion yuan, or 70 billion yuan, or $70 billion essentially gift. They're technically called loans, but we saw that as well, these forgivable loans. There's not an indication that these are going to be forgivable loans, but let's just say they're basically like candy. And they're loans to funds and brokers and insurers to buy stocks, plus an additional 300 billion yuan for companies to conduct share buybacks. So basically, companies in China can utilize the Chinese money printer, and investment companies and companies themselves can go prop up their own stocks with really, really cheap money. Goldman Sachs says it's really rare to see these sort of simultaneous cuts. And honestly, it's actually indicative of growing concerns that, oh my gosh, maybe things in China are actually way worse than we previously considered. And you're finally getting a China that's acting on the economic doom that they have been facing. Bloomberg says that this package is, quote, incredibly comprehensive, and they say it's aggressively targeted at the stock market with measures as well for the property sector, mortgage sector, and even consumer loans. A lot of people think that consumers are likely to respond to this by going out and spending money because they'll be able to pick up cheap loans as well. That's unclear at this point, mostly because when we've seen stimulus from the Chinese government before, the Chinese consumer tends to be very gun shy, mostly because when you get a stimulus from China, people in China understand that, wait a minute, we've been through this game before, maybe not as comprehensive as this, but we've been through this play before where we've trusted China and we've taken on more debt or we've taken on loans, and then all of a sudden what happens? You end up getting rug pulled with some kind of new lending restrictions. This was sort of like, hey, go real estate develop and build a bunch of real estate, and then we're going to come out with a 3 red lines policy and restrict your real estate lending, which drives companies into near bankruptcy and consolidation. So Chinese are definitely gun shy, but let's just say this is a good at least start to a U-turn in China that could potentially put a floor under some of the pain that Chinese stocks have seen, even those listed in the United States. For example, Baba stock is rallying on this. JD is expected to move higher on this. There's a lot of enthusiasm around this. People are calling this now an increasingly friendly environment for risk assets, especially since you now have China stimulating and you're getting a larger cut from the Federal Reserve, which we've got to talk about what this potentially means for liquidity and risk and bonds in the United States, which we'll do in just a moment. But I quickly want to mention, before we keep going here on China, quickly want to mention that stockhack.com is now live. So if you want an actual financial advisor in my office working directly with me about your financial situation to help you get to the next level of wealth by figuring out how are we going to balance your investments in stocks and bonds and crypto with potentially investing in real estate, getting your first rental property. If you want a financial consultant on your team, go to stockhack.com. The service actually goes live on October 1st, but we are already scheduling people to make sure that they are in line to get help as soon as possible if they're looking for it by signing up over at stockhack.com. You can either sign up directly, or if you'd like a phone call because maybe you have questions about the service, hey, is this going to be useful for me? You can book a consultation call as well to evaluate if this is right for you. So just go to stockhack.com and you get to learn a lot more. Anyway, a lot of folks are saying that this is not the kind of rally in China to fade. The last time Chinese shares rallied this much, Chinese shares ended up going higher for the subsequent 7 trading days, getting an average of another 5.4%. Before then consolidating and then moving higher yet again. So a lot of investment managers are looking at this and saying, okay, I will listen to what you are saying. analysts and Wall Streeters, and I will buy the dip on China. Whatever dip is remaining. And there's plenty of dip remaining in China. I mean, you look at a company like Alibaba. Alibaba in the pre-market at the moment is sitting up 5%. It was up 2% yesterday on stimulus hopes. And the stimulus that we got here is substantially greater than expected. And if you look at sort of the average growth here, really your next fib level should be around 118 for this stock. So you could really see Baba finally recovering. A lot of folks have been very opposed to the stock because the Chinese consumer has just gotten worse and worse and worse. And rightfully so, the economy has essentially been collapsing in China. And so this at least sets the stage for a start to central bank capitulation in China and the turning on of the money printers in China. It's worth doing a quick analysis just of the valuation of Baba. Baba is now about a $95 stock. It has earnings of expected at about $9 per share, which puts you at about a 10.4 PE ratio. With a 10.4 PE ratio, if you compare this to the growth that the company is expecting to have over the next 4 years, which it's not a clean road up, but it's a little bit of a bumpy road. But you've got about a 7.5% expected growth rate annually over the next 4 years. So if you take 10.5 divided by about 7.5, you're only sitting at about a 1.4 PEG ratio. A lot of people see that as, okay, a consumer stock with the potential of some revenues from cloud-based services and artificial intelligence data centers. Maybe now is the time to buy. Obviously, we saw a massive rally in China on this, but we also saw stocks in Europe on this. We saw luxury stocks up on this, like Kering, LVMH, Hermes, all on hopes of strengthened spending from that Chinese consumer. You've also seen oil jump on this, as well as copper and iron futures, which are, copper and iron being industrial metals. But gold is also moving up on fears that this might cause some more inflation, which we're going to talk about that and what that means for the bond market in the United States and the Federal Reserve here. But Brent is up 2% as of my last check here. And what's remarkable is it's actually fallen to a 3.5-year low just about a week ago, September 9th. So about 2 weeks ago, we were at a 3.5-year low on oil because of concerns that the Chinese economy was truly in recession. Well, now oil is spiking, which could also drive some of the inflationary concerns in the United States. Now, investors, obviously, some of them are going to be skeptical going into this, but again, people think maybe this is a floor, and that's why you're seeing so much enthusiasm. At a moment when consumer confidence has been near record lows, job concerns have been massive in China and have really started flowing over to the United States, and people see this as finally some relief, avoiding the continued demand destruction that's been occurring. Some people call this a policy bazooka that is likely to keep feeding this self-fulfilling rally. But think for a moment what this means for the United States. Yesterday, Goolsbee talked about many cuts coming in the United States, that we are potentially hundreds of basis points away from neutral. After this discussion, we actually saw bond yields fall as the bond market rallied, but that was quickly faded on thoughts of, but what if China stimulates more? And what if at the same time we're overstimulating in the United States? People are now making the argument that somehow a 50 basis point cut, which Milton Friedman refers to as the central banker in the shower. In other words, it's like, it's too cold. It's too cold. They turn up the heat. It's too hot. It's too hot. Like, they're making these rapid changes of a temperature that they might honestly be screwing things up, which the central bankers are generally pretty good at screwing things up. But what you've got is now fears that, oh my gosh, what if we actually reignite inflation combined with oil prices going up and the Chinese consumer getting propped up? Take a look at yesterday's PMI report. Yesterday's PMI report said that growth disparities persisted. There was a moderation in order book growth and a deterioration in business expectations for the year, heading ahead to a near 2-year low. In other words, business expectations went to a 2-year low for the year ahead, possibly because of election uncertainty, or possibly because the economy is actually starting to get hit pretty hard in the United States. optimism deteriorated sharply in the United States. However, there's also some concern that we've started to see prices actually move up a little bit. And this you could see in some of the charts that they give here. The prices chart, you're starting to see this slight expansion here, this above 50 reading in prices for manufacturing output prices, services output prices, services input prices, and manufacturing input prices, are leading some to say, uh-oh, could the Federal Reserve actually be creating stagflation? Now, I think most of the inflationary concerns are loony, but markets are pricing them in. I'm of a believer that we're going to be in an environment where markets become so loosey-goosey, that jobs become so readily available, that we're actually going to have massive wage deflation, and that supply chains are so loose and ready to support the additional demand and supply impetus from whatever source, whether it's China or the United States or whatever, that prices might actually deflate rather than inflate, especially, of course, if there's a recession. So I'm personally not heavily worried about inflation, but markets today are looking at this and saying, okay, this is interesting. If China's going to print money, that could cause inflation because y'all just shot oil prices up. And you got Goolsby, or some like to say Foolsby, who wants to go for mega cuts. That's all just going to cause inflation. You've even got people like Jamie Dimon who are like, geopolitics are getting worse, and I'm going to take a cautious outlook here on the future of what's going to happen in markets. So Jamie Dimon's not really all in on this sort of rally, but a lot of people are. A lot of people see this continuing. So we'll see. You've got people on all sides. You've got bulls saying stocks are going to all-time new highs. You've got bears saying we're going to have stagflation. You've got bears saying we're going to have a deflationary recession. That's more of the camp that I'm in, by the way. And you've got, frankly, China that's like, brr. This is a crazy environment that we're in. A lot of people keep an eye on companies like JD, Alibaba, luxury stocks, and some of the Chinese-related companies. Worth also noting that China, some people are like, oh, China won't allow stimulus to fail. Bro, stimulus in China has been failing for the last 4 years. All of a sudden, one day is turning all these analysts on their head going, oh, it's going to be great. But keep in mind, China also arrests people who have a different opinion. Like, they literally just arrested Zhu Hengpeng. I'm sure I screwed that up. He was criticizing Xi Jinping. He's a Chinese economist and a deputy director at the Cass Institute of Economics. And he was arrested for criticizing, Xi Jinping, little man. And this really comes amid what they're calling broadly, observers are calling broadly, a crackdown on negative commentary on the Chinese economy, Keep in mind, they also stopped publishing youth unemployment because it got so bad. They didn't want people to think it was actually that bad, so they just, monkey see no evil. Crazy. So, I don't know how much I trust China, but let's just say from a trade point of view, there could be a lot of enthusiasm around China in the near term. And what's crazy is you're actually seeing people rotate away from India on this towards China. With that said, thank you so much for watching. Go check out Stock Hack for actual personalized financial wealth planning from my team, directly in coordination with me. We'll be looking at your situations together as a team and helping make sure you can get into wedge deals in real estate if you want, stocks, and a balanced bond and crypto portfolio. Learn more over at stockhack.com. We are so excited to help you out. Thanks so much, and we'll see you soon. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.